Okay, so we have done this FCFF. Last time we did this FCFF and FCFE. Okay, free cash flow to the firm. That 4 ways I did. Then from there, FCFE. That is using 2 ways. So, which anyways I will repeat in FSA also. Okay, now coming to required rate of return, how do we calculate? Okay, so there are many ways to calculate required rate of return, but one of the most widely used one is called CAPM method. So required rate of return means, suppose you are investing in, SpiceJet, imagine company. If you are investing in an airline company, SpiceJet, how much should you expect from that company? So how much should you expect? Okay, that is called required rate of return. Required rate of return. Okay. So CAPM method says, CAPM means capital asset pricing model. Capital asset pricing model. Capital asset pricing model, as per this, required return is equal to risk-free rate of return, because anywhere there where you invest, imagine in the market, risk-free rate of return means the return that you will get investing in a 10-year government bond. So let me check that one. Okay, so here, so 10-year government bond yields in India. So this is 6.13 or 6.29. Okay, so 6.29 percentage. So you want anyways 6.29 percentage. Why? Because if you invest into government bond, there is no risk only involved. Plus, now you will see what is the market, how much is Nifty giving you. So now I will check 10-year CAGR return of Nifty. Okay, so here it is 11.9 percentage. Okay, so 11.9 percentage. So if Nifty is giving 11.9, so Nifty has given extra how much over the risk free? That much you want. That means 11.9 percentage minus 6.29 percentage. Okay, so that means now here, so here, how do I add this? Okay, so see 11 point, see when you want to add or minus percentage, don't do like this the way I'm going to do now. See here, the common mistake that people will make is 11.9 percentage. So they will select 11.9 percentage. Okay, oops, again, this format I have to change every time here. Okay, so 11.9 percentage. Okay, minus 6.9 percentage, minus 6.29 percentage is equal to, what happened? 11.9 percentage. So this again 11.9 percentage minus 6.9 percentage is equal to, I don't know why I'm not able to, I don't get anything here. Okay, you people do. What are you getting as the answer? Let me do here only 11 point like this only without uh, formatting. 11.9 percentage minus
It's
6.
0.1115.
Okay.
0.1115.
uh, I don't know why I'm not able to get. So
Like
so how
that's
much are you getting when you do like that?
like that. It's coming to 0.11 triple one five.
So 11.5 percentage is it?
Yeah. Yes, I think this one.
11.5, right? When you
Yeah, 11.15.
11.15. Okay, okay.
Right.
So this is
But
wrong.
this is
Okay.
wrong, right?
Yeah, this is wrong. You should not do like this. Why? Because when you take 11.9 percentage and then minus 6.9 percentage, it will reduce 6.9 percentage of 11.9.
Right.
Okay, of 11.9. It is not reducing 6.9, 6.29. It is reducing 6.29 percentage of 11.9. So what I should do is I want exactly 6.29 percentage to be reduced, not 6.29 percentage of 11.9. So what I should do is, whenever you want to add or subtract percentage, ignore percentage. Okay, and then you add or subtract. Whenever you want to subtract or add, multiplication, all those things are fine. So here 11.9 minus 6.29 is how much? So 11.9 minus 6.29, 5.61, right? So it is 5.61 and then you suffix with percentage. Is it okay? And then see again you have to add these two. So again ignore percentage and then suffix with percentage. So 6.29 plus 5 point,
It's 11.9.
yeah, this is coming to 11.9.
Yes.
How this is 6.29, no?
Yeah,
6.29
6.29 plus 5. What was it?
plus
5
5.61, 5.61,
plus
11.90.
11.9.
Acha, 11.9 you said, 11.90. So 11.90 and then I will suffix with percentage. So you do like this, or else you can simply convert all into decimal. 0.0629
There's also beta
plus,
over here, right?
yeah, I have to speak about beta as well. Okay, 0
RF
point,
plus beta.
yeah, 0.119 minus 0.0629. Okay, this way also you may calculate, and then after calculating all, just suffix, multiply by 100 to convert it into percentage. This is how you are supposed to do now. But now this formula is not perfect, because as per this formula 11.9 percentage you should get. However, you will say, look, nifty has, this is nifty has 50 stocks, those are all large cap, big company. But then SpiceJet is not a very big company, it is a small cap company. So because SpiceJet is not a large cap company, it's a small cap company, it is riskier than the market. So how risky is it, you want to know? That you will come to know through beta of SpiceJet. What do you mean by now beta? Beta will tell you how sensitive the stock of how sensitive is the stock of okay, how sensitive is the stock of uh, how sensitive is the stock of SpiceJet in comparison to the market. That means if market means nifty goes up by 1 percentage. By what percentage? By what percentage? Um, by what percentage SpiceJet will go up? Will go up. That is called beta. So suppose if the beta of SpiceJet is 1.2, if beta is 1.2, so if market goes up, if Nifty, market means Nifty, if Nifty goes up by 1 percentage, SpiceJet will go up by 1.2 percentage. Now let's find out. There is a formula for all this to find out beta, but we can get it ready made right now. So I'm directly typing beta of SpiceJet. Okay. SpiceJet share price. The beta for SpiceJet, okay, it is showing less risky. Uh, okay, so let me take some other company. Indigo is 83.83. Okay. Okay, fine. So it is less riskier than the market. Actually, no, this is the one, beta values of interglobe aviation. See, this is 1.5. Okay. Beta 1.5. Long-term beta is 1.5. So because it is 1.5, what does that mean? If Nifty is going up by 1, it will go up by 1.5. So I will take that risk also into consideration, beta. Okay, so beta. So this is 1.51. Okay, 1.51. So that means now let's recalculate. As per CAPM method, R is equal to risk-free plus 1.5 or beta of RM minus RF. So 6.29 percentage plus 1.51 beta into 9 point, no, 10, 11.9, correct? So this was 11.9 percentage minus 6.29
29.
percentage. Okay, so now how to calculate this? So this is how much is this extra from the market? It has given 5.61 percentage. So 5.61 percentage, but the risk in Indigo is higher, 1.51. Just multiply these two number now. 1.51 into 5.61 percentage.
So total I got it as 14.7611, like the final
Okay,
answer.
14.7611
Yeah.
percentage. So market is giving how much? 11.9, but you should expect 14.7, 14.76. Why so? Because you are taking more risk than the market. Is it okay? Okay. Shravani, you understood this one?
Yes, sir.
So you should expect 14.76 percentage from uh, Indigo. Now suppose same way if you calculate for Hindustan Unilever. So Hindustan Unilever comparatively it will have less risk. So beta of Hindustan Unilever share. So here it is C 0.37. That is too less. 0.37. Okay, 0.39 5-year beta. Okay, fine, 0.39. So then how will you do? So risk free 6.29 plus 0.39 is the beta plus 0.39 into return from the market minus risk free. Return from the market is 11.9 percentage minus risk free is 6.29 percentage. Calculate this and tell me what is the required return from Hindustan Unilever.
Eight point 4779.
Yeah, so 8.4779. Okay.
Yeah, fine.
Done. So even though the market return is more 8.77, correct? 8.7749.
8.4779. Yeah, 8.4779.
So even though the market is giving 11.9, you should expect only 8.4 from Hindustan Unilever because its beta is less. That means its risk in comparison to the market is less. Okay. This part, this is entirely called as market risk premium, also called equity risk premium. Okay. Market risk premium
RM
total.
minus RF, right?
Yes.
And not
This,
beta.
no, not beta. Market risk premium, RM minus RF, is called as market risk premium, also called as equity risk premium also. Okay. Fine with this, Capum. It's a very, very important one. Okay. So now this is not required. So this is this. Okay. Then preferred stock. So preferred stock means, see this one. A company's $100 par preferred stock pays $5 annual dividend and has a required rate of return of 8%. Calculate the value of the preferred stock. See, for example, now before we jump into preferred stock, you think about simple fixed deposit. So in a fixed deposit, okay, so in a fixed deposit, so there is fixed deposit. Imagine you have deposited, um, let's say you have deposited 1,000 rupees fixed deposit, and that fixed deposit is giving you every time 7%. So how much will you get? 7% means every year 7%. How much? Hello.
Yes, sir. 70.
7% of 1,000.
70.
70. So you are going to get 70 every year. So every year they are going to use your 1,000 rupees and they will pay you 70 rupees. That means in order to get this 70 rupees, what is the cost that you have paid? 1,000.
Yes.
Okay, so if I suppose if I don't know this cost, then how to find out the value? X into 7 percentage is equal to 70. So X is equal to 70 by 7 percentage. So this is this is so value of preferred stock, value of fixed deposit is equal to what? Equal to annual interest payment divided by annual interest payment divided by 7 percentage is what? 7 percentage is
7 by 100.
required
100 will go
required
to the
rate of return.
numerator.
Yeah, required rate of return. So this is the formula. Okay, so something which is every year paying perpetual, every year it is paying you 7%, imagine, then this is how you will calculate. Okay, annual interest payment divided by required rate of return. Same way, same logic. So this is the formula. Similarly, now value of preferred stock means here it is a perpetual one, it will keep paying you. Now because it will keep paying you, it will be annual dividends divided by R, required return. So here dividend is 5 annual dividend and required return is 8 percentage. 8%. Just calculate this, 5 divided by 8 percentage.
62.5.
So 62.5 is the price of the preferred stock. Okay. Now you might get doubts like this 5 rupees. How are we getting this 5 rupees? What is this 100 for? 5 rupees is the uh, is the amount that you are getting calculated based on 100, but required return only we should use to divide it by. Okay, because whatever rate initially was decided, let's say it was 5 percentage decided, so 5 percentage of 100 is 5 rupees. But right now how much you require in the market? You require 8 percentage, so that's why the value of the preferred stock should be 62.5. Okay, fine. Okay, then next one, Gordon growth. Yeah, very very important one. Gordon growth model. This is see, these are notations. Uh, these are the assumptions. When should you use Gordon growth model? Okay, Gordon growth means, imagine you
So
you
what was the first one? Like, what was the name of it? Dividend by required rate of growth formula.
first one means which one you are asking? This one?
Yeah, like dividend by required rate of return. The one which we just did right now.
Ah,
Yeah, this one.
this one what?
Yeah, what do we call it? Like this is also Gordon.
No, no, no. This is not Gordon. This is perpetual stock. Perpetual.
Okay.
Okay, when it is perpetual, that time we will use annual dividend or interest divided by R. If it is bond, it is interest. If it is, like here, fixed deposit, I used interest divided by R. So annual
Okay.
payment, general word is annual payment by R. That is for perpetual, value of your perpetual
Okay. Annual payment
stock.
by okay. Yes. Okay.
Mhm. So when should we use Gordon growth model? When we want to use dividend as the base to value the company. And when constant, okay, I think if we do the sum and then come back to this theory, you will automatically understand that. Okay. Gordon growth. So Gordon growth should be used when the company is consistently growing at a constant rate. Say for example, see, price is equal to so not price, R, required return. So this is another way to calculate required return from a stock is equal to dividend yield plus growth. So what does this mean now? Dividend yield means what? Dividend yield.
Like it's the percentage of dividend, right? Like, percentage of the face values.
Yeah, annual dividend payment that you are going to receive divided by current price of the stock. Current price of the stock. Current price of the stock. So imagine if annual dividend you are getting 8 rupees annually, and the current price of the stock is, or you are getting is 100 rupees. So 8% you are getting as dividend. That means, okay. So here coming to this one, R is equal to uh, dividend payments. No? So D1, expected dividend payment. Okay, expected dividend payment. D1 means expected dividend payment divided by P0 plus growth. So this is happening through dividends and this is happening through growth. Both are your required rate of return. So dividend, what you are getting, and this is the rate at which company is growing. So now you modify this. R minus G is equal to D1 by P0. So now on this basis, P0 is equal to D1 by R minus G. This is okay. Is this fine?
Yes, sir.
Yeah, P0. This is called Gordon growth model. Gordon growth model. Now we should use Gordon growth model only when growth is happening consistently at a certain rate. Growth is happening consistently at a certain rate, and also, our required return should be greater than G. Okay, and G should be consistent. And G should be consistent. Okay. P0 is equal to D1 by R minus G. Okay, Gordon growth model. This is the formula you have to remember, and this is the derivation. All these are the derivation. Like from here I started. Okay, but this is the formula that actually you have to know. Very, very important one. Very, so many times we are going to use this. Okay, now you see this question. Calculate the value of a stock that paid 1.50 dividend last year. If dividends are expected to grow at 8% forever means what? Consistency is there. So the moment you see consistency, you can use Gordon growth model. And required return is 8%. So you see R is more than the growth. So now you apply the formula. So dividend, expected dividend is what? If dividends are expected to grow at 8%, initially you got 1.5. So if I draw the timeline, this is $1.5. So now what will expected dividend will be what? 1.50 into 1 plus 8%. Just calculate how much it comes to. 1.50 into 1 plus 8%.
1.62.
1.62 is the expected dividend divided by R minus G. R is 12 percentage minus G is 8 percentage.
8%.
So this will be 1.62 divided by, again as I said, you should leave percentage and then minus. So 12 minus 4, 8 is 4 percentage. Now you calculate this.
So it's 40.5. 40. Yeah.
40.40
Yeah,
or
40.5.
40.50. Okay. Price.
Just finish and copy.
You want to copy? Okay.
Done.
Oh, yeah.
Yeah.
Mm, one second. Done, right? Okay. So see, when you use these words, when you see these words, forever, infinitely, indefinitely, for the foreseeable future, in all these cases, uh, Gordon growth model we should use. Okay. And D1 refers to expected dividend, not the dividend paid lastly. Okay. Yeah. Now next one. Okay. See, they are using notations. KE means cost of equity. Okay. K stands for cost here. Cost of equity. GC stands for constant growth. Okay. And D0 is the dividend already paid. D1 is expected dividend. Okay. D1 is expected dividend. GC means constant growth. The amount of estimated stock value due to dividend growth. Okay. Using the data from the previous example, calculate how much of the estimated stock value is due to dividend growth. Okay. How much is due to dividend growth? So the price is 40.50, correct? So 40.50. Now, when it is 40.50 is the price. Now we can categorize into two parts: no growth and with growth. Now, no growth means, so when I say no growth, we will use that perpetual method. No growth. Every time you are keeping 1,000 rupees in the bank, and every time they are giving you 7%, 70 rupees. So there is no further growth. So for that, the formula will be dividend, dividend without any growth. So without growth, what is dividend divided by R? So how much were you getting without any growth? You are getting 1.50, right? Without growth, you are getting 1.50. This one. So 1.50 divided by R. So R is what? R is here, right? R is 12 percentage. It is the continuation of the previous sum only. No? Just calculate this.
It's 12.5.
So that means if the company wouldn't have been growing, okay, its stock price would have been 12.5. But
Okay.
now it is 40.5. So the remaining price is for the growth. So remaining is what? 40.50 minus 12.50. Just calculate this.
It's 28.
28 is because of the growth. Okay, so now the question is, due to dividend growth, market is willing to pay 28 rupees extra. Is it okay?
Yes.
Fine, I'll move to the next one. Okay. Sustainable growth rate. So sustainable growth rate, how do we calculate? These are all very important sums, okay? Because this is the only chapter or only reading in CFA equities where sums are there. Rest all initially it was all full of theories only anyways, right? So very important one. Same things are there in level 2 also, okay? So more you practice it is good, and for sure this kind of questions also will come in the exam, okay? So now here, sustainable growth rate, how do we calculate? So growth is equal to return on equity into retention rate. Okay, return on equity into retention rate. That means overall return on equity. Imagine 1,000 rupees you have got return. Out of that, imagine retention ratio. Retention ratio. Let's say 60 percentage is the retention ratio. What happened to the remaining 40 percentage? Remaining 40 percentage you have paid out as dividend. So retention ratio is equal to 1 minus dividend payout ratio. Dividend payout ratio. So 1 minus, let's say 40 percentage. So that is equal to 60 percentage you are retaining. So what you are retaining, by that only you are growing. Okay. Acha, this is okay. 1 second. I have used amount. Wait. Let me use uh, return on equity into retention ratio percentage. Let's say return on equity is 15 percentage and retention is uh, 60 percentage. Just calculate this. Now this time now you can use directly 15 percentage into 60 percentage directly, and whatever you get converted into percentage.
9%.
So growth is 9 percentage. Okay, you leave this one here. I used all amount. Okay. So this is fine. Growth is 9 percentage.
Yes, I'll write it. Just
Okay. Okay, let me explain more than you, right? See.
okay.
Now, how do I calculate retention ratio? Retention ratio is equal to 1 minus dividend payout ratio. Dividend payout ratio. Okay. Now, how do I calculate dividend payout ratio? Dividend payout ratio is equal to dividend per share divided by earning per share. Okay, dividend per share divided by earning per share. Okay, say for example, if earning is 10 rupees per share, dividend paid out is 4 rupees. So that comes to how much? 40 percentage. So 1 minus 40 percentage will come to 60 percentage dividend payout. Retention ratio will be 60 percentage. Now you write down dividend payout ratio is equal to DPS by EPS. Okay, it's a very important one. Highly, very high chances of asking this question.
Done, sir.
Okay, yeah. See, they will give you questions like this. They will say, Acha, what is the formula for return on equity? By the way, return on equity's formula is uh, return is earnings, earnings or net income divided by equity. Okay, average equity. This is the formula. Now, suppose if they say return on equity is equal to, let's say, 20 percentage, and dividend per share is equal to 3, earning per share is equal to um, 10. Okay, what is the sustainable growth rate? Can you try now?
Yes. Is it 0.14?
0.1 growth rate?
No, like, yeah, G.
No, there is a mistake. Shravani, are you doing?
Yes, sir.
So I got dividend payout ratio is 30%.
Hmm.
And
Correct.
then 1 minus 30% is 70.
Hmm.
So 70% into 20%, right?
Hmm. Hmm.
So zero point 0.7 to zero point 0.2. So 0.14, right? This thing. G is
14
0.
percentage. Did you say you said 0.1 only, na? 14
No, I said zero
percentage.
point 0.14. Yeah, yeah.
14 percentage. Then it is fine. 14 percentage. Yeah. 14 percentage. Okay. Why? Because again, growth is equal to return on equity into retention ratio. Return on equity is given. Retention ratio, how do I calculate? Retention ratio is equal to 1 minus dividend payout ratio. So dividend payout ratio is equal to DPS by EPS. DPS is 3 by 10. That is equal to 30 percentage. So 1 minus 30 percentage. So retention ratio is equal to 1 minus 30 percentage, 70 percentage. So 20 percentage into 70 percentage is equal to 40 percentage. Okay. So this is 70 percentage. So growth is equal to, acha, here itself I did 12, 14 percentage. Okay. Then next one, Shravani done.
Yeah.
Okay. Yeah. Okay. Now a firm with no current dividend. Acha, this one we have not done. Try this one now. It's a direct, straightforward one. Acha, try this one.
Yes, sir.
Green Ink is expected to pay dividend equal to 25 percentage of earnings. So that means dividend payout ratio is 25 percentage.
25%. 15.75. But
Yeah. Okay. Shravan, you need help?
No, sir, got it.
Got it. Okay. The next one, a firm with no current dividend. Okay. Let's go through this question now. Okay. The firm currently pays no dividend but is expected to pay a dividend at the end of year 4. Year 4 earnings are expected to be 1.64 and the firm will maintain a dividend payout ratio of 50 percentage. Assuming a constant growth rate of 5 percentage and a required rate of return of 10 percentage, estimate the current value. See, no dividend and is expected to pay dividend at the end of the 4th year. Okay. At the end of the 4th year. So 1, 2, 3, 4. The firm currently pays no dividend but is expected to pay a dividend at the end of the 4th year. Year 4 earnings are expected to be 1.64. Earnings 1.64. And the firm will maintain a dividend payout ratio of 50 percentage. So therefore, dividend paid will be how much? 50 percentage of this. Just calculate how much. 1.64 into 50 percentage.
0.82.
So 0.82. Okay, 0.82. Now, and the firm will maintain a dividend payout ratio of 50 percentage. Okay, assuming a constant growth rate of 5 percentage and required return is 8 percentage. Calculate the current
RSN
value.
G is 5.
Yeah, this divided by 10 percentage R minus G. Just calculate this one. That means 0.82
Divided by
divided
zero
by
point
5
zero 0.05.
percentage. Yeah, yeah.
So it's 16.4%.
Yeah, so when you say 16, not percent, how will it be percent? 0.82 divided by 0.05.
05.
Huh. How much is it coming
It's
to?
16.4. Okay, so
Ah,
the price, it would be the price,
ah.
right?
So when we say 16.4, so
It is
that means,
P0, right?
yeah, this is P0 is equal to D1 by R minus G. So this is D1 is next year. So P0 is the previous year. That's why it will push the price to the previous year. And how much you got? 16.4.
4.
So this is for the third year.
Third year, okay. Yeah.
Okay. So how much is the price over here? That is the question. Times 0. So it will be, then you do normal discount. 1 plus 10 percentage required return raised to 3.
Okay. So,
Discount this.
divided by 1. So is it,
Hmm.
it's 12.3215.
12.32. Okay.
Yes.
Fine. Okay. Understood this one.
Yes, yes.
Then next one, multi-stage growth. Fine. Multi-stage growth. Multi-stage growth. Consider a stock with dividends that are expected to grow at 15 percentage per year for 2 years. Okay. Multi-stage growth means it is growing at different rate at different time period. Okay. Consider a stock that, with dividends that are expected to grow at 15 percentage for 2 years, after which they are expected to grow at 5 percentage per year indefinitely. Okay, first 15 percentage for 2 years, then 5 percentage indefinitely means constant growth. The last dividend paid was $1. Cost of equity. Cost of equity is also called as required return on equity. Both are same only. Okay, and calculate the value of the stock using multi-stage growth model. Okay, so yeah, so lastly paid dividend was $1. So this is $1, and then for 2 years 15 percentage per year. So into 1 plus 15 percentage, if you calculate, it will become 1.15. Correct? Okay, this is for the first year. Again, it is growing at the rate of 15 percentage. Just calculate this one. 1.15 into 1 plus 15 percentage is how much?
1.3225.
Okay, and then okay, 1.3225, and then further, uh, from here on it is growing at constant rate. Correct? Yeah. So from here on it is growing at constant rate, right? So now, so this will be my d1 divided by r minus g. So it is growing at the constant rate of what?
5%.
5 percentage.
5%.
Okay, yeah. So here I'll say it is growing at 5 percentage. Just calculate that.
So it's 1.388625. So like
1.388.
1.625.
Okay, 1.3886. Okay, 1.386. Okay, here they mentioned 1.38, 1.3225. Okay, that is all fine. So 1.3886 divided by R is what? R is 11 percentage.
Is 11.5%.
Minus G is 5 percentage. Yeah.
But
Calculate this.
divided by point zero 0.06. No, it's 23.1433.
Um, 23 point.
1433. So this is
Okay,
the price of like year two.
year 2. However, we want the price over here,
Yeah.
and we are receiving this payment as well.
So we'll divide
And
it by 15%, right?
now this total amount, how much it comes to, because we are receiving this payment as well.
Okay, yeah.
So just
Just
add
like
1.3225 plus 23.144,
this one.
1433,
3225. It's 24.4658. 5.
24.4658.
Yeah.
Okay. And here I'm receiving 1.15.
So
Okay. Now
we'll have to
both
add
I
this one
will
also.
discount. No, no, no. This is for different year, right? So I will
Yeah.
discount it at 11 percentage for 2 years. I will bring it here. This I will discount it at 11 percentage for one. I will bring it here, and then add up these two. So first one 1.15. You discount this. What are you getting?
So it's 19.85. Like
19.
you can make it
Acha,
19.86. So yeah, let's keep it till two digits.
this part, right? Second part or
Yeah.
overall? This one,
Yeah,
right?
only the second part. Yeah.
Second part is 19.856.
Yeah. The price is 19.856.
Okay, the first one.
The first one doing also.
Hmm.
It's 1.036
1.036. Okay, adding both, how much?
plus 19.85. It's 20.892.
Okay, 20.892.
Yes.
20.892. Yeah, 20.86. That is all fine. Those are all decimal stuff. Is it okay? You understood this?
Yes, sir.
Okay, so I'll move to the next question. You want to write anything?
Uh, I'll copy it later, like where we'll have the recording steps here.
Okay, fine.
Otherwise, it will take time. This one.
Yeah, yeah, right. Okay. So this number is not very clear. You do 20.892 minus 1.036, you will get it. 19 point something is there.
Yeah, 19.856.
Acha,
I think so. Yeah, it was
856.
19.856.
Okay. Okay. The next one. This module quiz all you try later on, and then you ask me questions. Okay. They're all easy sums only. All these are. The next one, relative valuation. Relative means, remember, uh, I told equities
Like
are,
comparing it to
yeah,
different, like
like
all those
first one
multiples,
is dividend discount model, second one is relative valuation, third one will be enterprise value, fourth one is asset based valuation. So now we are moving to the second one. Okay, relative. We are moving to the second one, relative. Now see, price to earning. This is the most popular one in the second group, relative price to earning ratio. That means to earn 1 rupee, how much the market is willing to pay. Okay. To earn 1 rupee, how much is the market willing to pay? Fine. Okay. To To earn 1 rupee, how much is the market willing to pay? So here, uh, price to earning, you can use price to sales, price to book, price to cash flow. So when should we use which one? Normally, price to earning is only used for maximum companies. For any normal manufacturing companies, price to earning is used. Price to sales should be used for those companies where the earnings are not good. That means earnings, let's say company is making losses. If company is making losses, then how can you value based on price to earning? Because this earning is in negative term, then the price will also go into negative only then. So if I imagine the company's share price is 20 rupees, earning is minus 2 rupees. So minus 10. Now that is not making sense. Now the price is minus 10. So that time we can use price to sales ratio. Okay. Or imagine you don't trust all the calculations that they have done. So that time also you can go for price to sales, because sales is the most pure, purest form. Because after sales, everything, cost of goods sold, then gross profit, then sales general administration. Imagine you don't believe in all these numbers. The cost of goods sold, whatever they have done, you think that a lot of right accounting they have not followed. In all these cases, or depreciation they have manipulated. Okay, but you are still interested in the company. Okay, then the best one is earning after tax net profit. You can simply go for sales is the purest form. Okay, yeah, just 1 minute. I'll connect charger to my laptop. Okay, fine. When should we use price to book ratio? Now price to book ratio, see, book means what? Book value per share. Book value per share means what? That means this is the asset balance sheet and this is the asset side. Asset minus outside liabilities. Okay, all these are outside liabilities. Like what? Like bonds, current liability. Okay. Then what do we get? We get equities, retained earnings, okay, reserves and surplus. All these are book value. Okay, that means shareholders' equity. It is also called book value. Divided by number of shares, we will get book value per share. Now, when do we value a company based on price to book value? Example, see, now a bank. Typically, a bank should be valued based on price to book value because uh, okay. Uh, because see, uh, let's say, see what work does a bank do? Bank is normally a manufacturing company. What work do they do? They are manufacturing something and they are selling and they are getting cash. So they are doing the work of taking cash from the customers. And what work does a bank do? Bank is doing the work of giving cash to a customer. So which one is difficult? Manufacturing or bank? Manufacturing is difficult, right? Because you have to give product and you have to take cash, and that is difficult to get cash from somebody. Whereas bank is doing the work of giving cash. It is very easy. You keep giving loans to anybody and increase your sales. and increase your net profit. Okay, so that's why it is not a bank's talent to keep giving cash. It is about after giving cash, how much they are recovering the amount. That's where that bank's talent comes into play. How much can they recover? So when they recover, when they keep recovering, where will that money go? All that over a period of time, all this net profit will go to this retained earning only. And that's why whatever they have recovered, on that basis, I want to value this company. So price to book value. You understood the reason? Price to book value.
Yes, sir.
Okay. Price to book value. Okay. Another example can be something like very capital intensive company. Just imagine L&T. Now L&T is a very capital intensive company. So what do they do with the money? They keep buying assets. They will have a lot of big assets, right? Building, machines, cranes, and all these big machines. They will have to keep it handy. So this way, the assets of the company is very high. Okay, so when the assets of the company is very high, they want, so such kind of company also we can value using, uh, price to book value. Okay, so these are the companies which we value. We should not value. These are the companies we should value using price to book. We should not value IT company using price to book. Why? Because IT company will not have any assets. They don't have any big machinery because their only machine is what? Laptop and employees. Employees are not shown as the asset in the balance sheet. So that's why you will not find much assets for IT company. So IT companies, we should not use price to book value. Okay. So in short, we should use price to book value for banks. Typically lower than two is considered as a good one. Price to book value lower than two is considered as a good one, typically. Okay. Okay. Price to cash flow directly, very few people will use it. You can use as a second mode of confirmation. Because why do we use cash? Reason being, see, when you don't trust earnings, or when you think, why you don't trust earnings here, why you want to think about cash? Remember last time I did free cash flow to the firm. Free cash flow to the firm. From net income, we are calculating free cash flow. Why? Reason being, quite possible that this net income might have too many non-cash items. Okay, so just like, you are going for a job, I mean interview, and they are asking what is your expectation from the job, how much are you expecting? So you are saying my expectation is one, or they are saying, imagine your salary is 1 lakh. Now when they say 1 lakh, your next question will be, what is my take home salary? Because that this 1 lakh may have many perquisites, like, transportations, cafeteria charges, and all that thing. Maybe after deducting all, you will get only 70,000. Okay, so for that reason, uh, okay, you want to have clear idea how much, cash you are going to get in your hand. So actually it is 70,000 only. Rest 30,000 you are not even seeing it. Okay, similarly here also, how much cash it is generating? Is it that they are doing all credit sales and increasing the earnings? So at the ground level, there is no cash only coming. So that's why this is cash also can be used. How much cash is there? Only that I am believing. Like here, I believe only 70,000. Rest all I am not seeing only. So similarly, whatever cash is coming out of this net income, only that I am going to believe. That is cash flow. Okay. Now, normally people use earnings only, because if you use cash flow, then you are being too strict. Then you might miss a good company also. Okay. Yeah. Now, how do we calculate, see, justified PE ratio? This formula, okay, justified PE ratio. Justified PE trailing ratio is equal to, justified PE trailing ratio is, say, trailing means based on the past data. So now this also Gordon growth model only helps. See this here, how it works. P0 is equal to D1 by R minus G. This is Gordon growth model. Now what will I do? I will divide by E0 both the sides. Then this will become D0 by E0 into 1 plus G. As 1 plus G only becomes D1. Okay, divided by R minus G. That is equal to, this is dividend payout ratio into 1 plus growth divided by R minus G. That is equal to dividend payout ratio. I can write as 1 minus retention ratio into 1 plus G divided by R minus G. That I can further write as, see, the book is using the notation B, okay, instead of, many times instead of retention ratio. So when they say B, you should think about retention ratio. This is the formula. This is okay. You should know all this formula, but there is nothing to remember. It is just you have to practice couple of times. It will stick to the head. What I suggest is, you should buy one rolling whiteboard paper from your stationery shop and your duster and marker, and you should write all the formulas there and hang it to the wall. You will be, believe me, it will really help you to remember the formulas. Okay, you don't have to struggle at the end. Okay, now there is
So what
another.
is
What is what?
EO? EO. There is E0, right? So
E0.
yeah.
E0 means, yeah, earnings, past earnings. Okay. Now similarly, I'll go with justified justified uh, so I should say trailing PE ratios instead of saying PE trailing ratio. Okay. Justified leading PE ratio. Reading is also called forward PE ratio. Okay. So this one is, see, P0 is equal to D1 by R minus G. Now divide by E1 both the sides. E1, okay, that means expected earning, forward. This is forward looking. So D1 by E1 is dividend payout ratio divided by R minus G. That is equal to, dividend payout ratio is 1 minus retention ratio divided by R minus G. That is equal to 1 minus B divided by R minus G. This is the formula. Okay, so here you have 1 plus G extra. Here you do not have. Is it okay?
Yes, sir.
Now
Yes,
let's
sir.
see this formula. Okay. A firm has an expected dividend payout ratio of 30% and required rate of return of 13 and an expected dividend growth of 16. Calculate the firm's fundamental justified leading. So leading means from this you have to use one formula. So they are saying dividend payout ratio is 30%. So I can use this one, 30 percentage divided by required return is 13 minus growth rate is 6 percentage. Just calculate this.
So 0.4285.
0.4285,
Mm,
4.3.
Okay, point zero, just yeah, 4.28. Sorry. 4.28. 4.285.
So that is 4.3. That means to earn 1 rupee, the market is willing to pay 4.3 rupees. Okay. To earn 1 rupee, the market is willing to pay 4.3 rupees. Now you have to compare it with other similar kind of company stocks and find out whether it is, suppose if other companies are trading at 7, okay, for 1 P ratio, okay, for earning 1 rupee, other means similar in the same industry, other companies, then this is undervalued less. Okay,
Like,
so this is 4.3. Yeah. Dividend displacement of earnings. Other things are not equal. An increase in the dividend payout ratio, for example, will reduce the firm's sustainable growth rate. While higher dividends will increase firm value, a lower growth rate will decrease. Higher dividend rate will increase a firm value, a lower growth rate will decrease. This relationship is referred to as dividend displacement of earning. This net effect on firm value of increasing the dividend payout ratio is ambiguous. As intuition would suggest, firms cannot continually increase their P or market value by increasing the dividend payout ratio. Otherwise, all firms would have 100% payout ratio. Okay. Mhm. Basically, when you keep paying more and more dividend, they're saying higher dividends will increase your firm's value. But then the growth will be less than a lower growth will decrease. So paradox. On one side, higher dividend will increase the value, and on the other side, when higher dividend is being paid, lower growth will happen. Lower growth will decrease the firm's value. So that is dividend displacement. Okay. Okay, just this is, you will not get this kind of theoretical question. This is just for your understanding. Okay. Holt Industries makes decorative items. The following figures are for Holt and its industry. Dividend payout ratio 25, 16, 7.5, 3.9, 113, 68%. Okay. So here, which of these factors suggest a higher fundamental PE for Holt? So assuming the P ratio is very high, so what would be the reason for PE to be high? See, in the industry, dividend payout ratio is 16 percentage, but Holt is paying 25%. So is it good or bad?
so can you repeat the question?
Huh? In the
Can you please
industry,
repeat?
yeah, in the industry is paying 16% dividend payout ratio. Holt is paying 25%. That means they are paying more dividends in comparison to the industry, which is a plus point.
Yeah.
Okay, sales growth. Market industry is growing at 3.9, whereas Holt is growing at 7.5%, which is also what? plus point.
Good. Yeah, plus one.
And this one, industry is growing at 68% when it comes to debt to equity ratio. You want debt to equity ratio to be higher or lower?
Lower, lower,
Lower. Debt should be lower.
lower.
So that's why, but here you see Holt's debt to equity ratio is very high.
Yeah,
So overall, they are saying P ratio is high. So out of all this, what would be the reason? Uh,
because like since there's more risk, there are more returns. Right?
P ratio is high. That means market is ready to pay more. That is because of these first two reasons: high dividends and high growth.
High growth.
Because of these reasons, third one cannot be the reason because the debt is very high.
Yeah,
If the debt is very high, then people will not be ready to pay highly. The price will come down. Imagine a too risky company will be there. So then what will happen at that time? Too much of debt that company has borrowed. Then the price will come down. Na? Okay. Okay. You may read the theory, this part quickly.
okay. So
Is it
so can
okay?
you explain these points?
See, higher dividend payout ratio supports Holt having a higher PE than the industry because it is a plus point. These are plus points for which you would like to pay more.
Okay,
Then second one, higher growth in sales suggests that Holt will be able to increase dividend at a faster rate, which supports Holt having a higher PE than the industry. So more sales, more dividends they are going to pay.
great.
Then third one, the higher level of debt, however, indicates that Holt has a higher risk and a higher required rate of return on equity, which supports Holt having a lower PE. Okay, so this will pull the price down. This is negative. For this reason, people would not be interested in paying highly. So first 2 points are the reason why high PE ratio is there for Holt.
Okay.
Okay.
You can have a 5 minutes break.
Yeah, yeah. Okay. So we will take 5 minutes break. Yeah, it's ten
We'll
thirty.
come back
We'll
10:35.
come 35. We'll come back. Yeah. You just leave it like this only.
Okay. Hello.
Yeah. Okay.
Yes.
Okay.
Okay, we'll continue. Okay. Yeah, you can see the screen still, right?
Yes.
Okay. Then valuation using comparables. Valuation using comparables. Okay, just go through this question now. It looks big, but it's actually all easy one only. Just take a minute and quickly go through this question. Okay, see, the following figures are for Rennie's Bakery. All figures except the stock price are in millions. Okay, except the stock price. That means except this one, 11.4, this part. Rest everything is in millions. Okay, stockholders equity. Stockholders equity means book value. Okay, book value and stockholders equity are same. Net revenue, net income, net cash flow from operations, stock price, shares outstanding. Calculate Rennie's lagging. Lagging means trailing. Okay, lagging is also called trailing. So trailing P ratio, you can even call this as lagging P ratio. Calculate Rennie's lagging PE, price to cash flow, price to sales, and price to book ratio. Judge whether the firm is undervalued or overvalued using the following relevant industry average for 2003 and the firm's historical trend. So lagging industry ratios, price to earning. This is the industry's ratio. Okay. Price to earning, price to cash flow, price to sales, price to book. First one is price to earning. I need to find out, then I will match it with the market. So I am doing for, uh, I'll do for 2003. Later on, you can practice for 2001 and 2. Okay. So here, price to earning ratio. So price to earning ratio. How do I calculate? Price is 11.40. Earning per share I want. Per share earning means net income. But this is not per share. This is total, right? Because they said all these, this is millions, 3.2 millions. So I want earning per share. Earning per share is equal to total earnings divided by number of shares. So earning is how much? Earning 3.20 divided by number of shares. So number of shares is
4.476 million.
4.476. Just calculate
It's
this.
0.7149.
0.7149.
49.
So this is earning per share, 0.7149. Just calculate this now.
It's 15.95.
15.95. Okay, so let's check the answer also. 15.9. So 15.9 and industries it is 8.6. Okay, this is for industry. So price to earning is what? Higher than the
I.
industry. Okay, then next one. So similarly, you try for 2002 and 2001. So I'm doing for 2003. Okay, the next one. price to, what is that? Price to cash flow. Price to cash flow is, this is price. Again, cash flow, I want cash flow per share because this price is per share. So cash flow per share, how will I get? Cash flow per share. So cash flow per share is 17.9 divided by number of shares, 4.476. Just calculate this.
3.999. So 4. Yeah, it's rounded.
3.999.
Yeah,
Okay, so 3.999. Just calculate this now.
it's 2.850.
2.850.
Yes.
And the market one is 4.6. Okay,
So
so
what was
price
it?
to cash flow.
17.90.
Huh?
What was this amount? 17.90.
This
Okay,
is
this is
total
net
cash flow
cash flow from operations.
operations, total. Okay.
Yeah.
Okay, fine, right? This is all okay. Then uh, price to cash flow is done. So price to cash flow is price to cash flow is lower. Okay, then next one, price to sales. Price to sales. So price is for 11.40. This is sales per share is how much? So sales is 77.30 here divided by per share. Sales is per share 4.476. Just calculate this.
17.27.
So 17.27. Just calculate.
Yeah, it's 0.660.
Okay. Whereas in the industry, it is price to sales is 1.4.
1.4.
So it is better, lower price here also. Then price to book value. Price to book value. Price is 11.40 and book value means book value per share is equal to book value means shareholders equity 55.60 divided by per share 4.476. How much?
12.42. 12.
Hmm.
It's 0.9178.
Okay, so here also industry perspective
I
it
think it's
is
more, yeah,
3.6.
3.6.
So again very less. So all qualities are good, and so that's why price to earning is very high.
Except
Rest
price
all,
to earnings, right?
rest all are good. Okay, that's the takeaway point. That you can read all this. Only this one will be given there. Okay. The next one, EV ratio. EV, enterprise value. Now, what do you mean by enterprise value? So now we are going to the third one. So I said it is dividend discount model, relative valuation model, then enterprise value, then asset based valuation. So now we are going to the third one, enterprise value. So enterprise value, when is this used? Enterprise value is used when you want to acquire the company. So because when you want to acquire the company, you are not worried about discounts. You are worried about what is the total earnings. So EV multiple formula is like this. EV multiple is equal to uh, EV divided by EBITDA. This is the formula. Okay. Why am I focusing on EBITDA? Why not net income? That is because okay, in this income statement, why EBITDA becomes more important for me, because this is the true business happening. Depreciation, you know, is a non-cash. Interest, if company is acquiring, quite possible that company might pay off that debt. Okay, and and the and the profits will come, very highly positive. So this is the actual business operations is happening here. So company is interested, company is paying for this amount, EBITDA. Okay, so that's why when you are acquiring a company, you are most interested in EBITDA. Okay. So, and what is enterprise value? Enterprise value means market value of equity plus market value of debt plus market value of preferred stock minus cash and marketable securities. Cash and cash equivalents or cash and marketable securities. That means all this money, this you have to pay. But when you pay, you will get the entire company. So whatever cash is there in the company, that is also yours. So your value is coming down there. The value of the company, the valuation comes down there. This is the enterprise value. You have to pay for using their equity, for using their debt, for using their preferred stock. All money you are using. Okay, but because when you acquire the company, this is the benefit for you. Cash, all cash in different plans in the accounts, you are going to get it. So that is reducing the value of the company. Is this formula making sense? Are you convinced or you need clarity anything here?
No, sir, understood.
Hmm. Okay. Okay. Yeah, so this is the formula. Now let's look at this. See, if market value is not there, then we will take book value. Okay. If market value is not there, we will take book value. Remember, in any of this. So this is the formula. Go through this now. Just read the question, then I'll do the sum. I think this is the last. No, after this there is only one sum. That is the last. So we can finish today itself. It will not. It's not difficult. Just quickly read.
So why did they deduct book value of long-term debt from total debt?
Why did we deduct what?
Uh, Long-term debt from total debt.
Okay, I'll explain. Yeah, see. Daniel Inc. is a manufacturer of small refrigerator and other appliances. The following figures are from Daniel's most recent financial statements, except for the market value of long-term debt. Okay, market value of long-term debt. There is some problem. Okay, which has been estimated from the financial market data. Okay, stock price, shares outstanding, market value of long-term debt, book value of long-term debt, book value of total debt, cash and marketable securities, and EBITDA. Okay, see, first of all, EBITDA is directly given 1 million. So easy, that one. Market value of equity. Uh, Market value of equity. Okay, market value of equity is this one, 40 into 200,000. This will
Yes.
be 40 into 200,000, correct? This is the market value, number of shares into price per share. Then market value of long-term debt. Okay, here you see market value. See here, when I say market value of debt, it means total debt. So in this total debt, total debt is uh,
2.1.
book value of total debt is 2.1. Okay, so book value of total debt is 2.1 million. Out of this, book value of long term debt is 900. So book value of long term debt is how much? 900,000. Then book value of short term debt should be what? It is not given. Okay, here they have given market value. So this one, it's market value. Market value of long term debt is how much? Market value of long term debt is 600,000. So what should be the book value of short term debt? Book value of long term debt is 900. Total book value is 2.1. So remaining should be short term debt, correct? Is it fine? Yes or no? Understood or not? Okay, so
Yes, sir.
this comes to what? How much? Calculate.
1.2
1.2, no?
million.
1.2 million.
Hmm.
So 1.2 million. Okay. Now I said if market price is given, you should go with market value, market price or market value. So I don't want this one. Okay. Here I will go with this one because I don't know the market value. So it will be 600,000 So whatever value comes here, it will be 600,000 plus 1.2 million. Okay. Preferred stock is not there, so it is 0. Not there, right? Not there. Then cash and marketable security 250. So minus 250,000. Understood? Just
Yeah,
calculate all this now.
that is 8 million. 9,550,000. $550,000.
This is EV. Now what we want is EV by EBITDA.
Yeah, EBITDA is
So
given.
so
EBITDA is
9
1
and
million.
yeah. Now you calculate this.
That's 9.55.
9.55. So this is the EV multiple. That means to earn 1 rupee, the acquirer is paying 9.5 rupees. To earn 1 rupee, the acquirer is paying 9.5. Generally around 7, 8, people, companies pay. What does this mean? That means, see, to earn 1 rupee, you are paying 9.5 rupees. That means after 9.5 years, this company is free for you. No, that's what it means. After 9.5 years, this company is totally free. Okay. Is this clear? Understood this one?
Yes.
So any company, when they are acquiring another company, in the newspaper, when you read, they will speak about this EV multiple and all those. Okay.
Yes.
Okay. Then next one, yeah, approximately 9.6. That is fine. So if the competitor or industry average is above 9.6, then it is undervalued. Good one. If it is lower below 9.6, then it is overvalued one. Okay. Then the last one, asset based one. Very easy sum only. We'll just finish it up. It will be over. Okay. Just go through this question now. Asset based. Last one. Asset based model. So this is asset based model. Asset based model. Similar color. Just go through this question.
Done.
Okay. Yeah. So here, William Optical is a publicly traded firm. An analyst estimates that the market value of net fixed asset is 120% of book value. So we are supposed to take market value. Okay. So the market value is 120% of book value means what? If book value is 100, the market value is 120. The liability and short-term asset market values are assumed to be equal to their book value. Okay. So only this is the case. Net fixed asset only we are changing. The firm has 2,000 shares outstanding. Using the selected financial results in the table, calculate the value of the firm's net assets on a per share basis. Okay. So asset based model. Now here, uh, so assets minus liabilities, asset minus outside liabilities. Okay. So assets, see cash. Assets is cash 10,000. Accounts receivable 20,000. Inventory 50,000. Net fixed assets 120,000. Now net fixed assets, they said net fixed assets, they said 120% of book value. Net fixed asset is 120% of book value. So 120% of book value means what? If book value is 100, it will be 120 market value. And here net fixed assets is 1,20,000. So what should be the market value? So 1,20,000 into 120. Just calculate this. It will come to 1,44,000. Okay. So I'll take the market value 1,44,000. I understood this one. So this is my total assets. Now you count all this.
So it's 224,000.
This is assets we have got. Liabilities, they said it is as per the book value only. So I'll take all liabilities. But outside liabilities means I will not include this common shareholders equity. So liabilities will be outside liabilities. Liabilities will be total is 2 lakh minus 1,20,000. Rest all is our outside liabilities. So 2 lakhs minus 120,000. So 80,000. Okay.
So it's 144,000.
So this is assets. This is minus outside liabilities.
So
So difference
144,000.
144,000. So 144,000 is the book value. Okay, or not book value, like net assets, right? Net assets. Okay, net assets. So net assets value per share. So this is net assets per share. Net assets value, because I want per share, I will divide it by number of shares. Divide by number of shares. Number of shares is how much? 2,000 shares. Just divide by 2,000.
It's 72.
Yeah. So the formula will be like this. Net asset value is equal to assets minus outside liabilities
Upon
divided by number of shares.
number.
So that comes to 72. Okay, so this is 72 per share. That's it. Okay, most likely they will ask you dividend discount model, Gordon growth, sustainable growth ratio, relative valuation. Okay, those are the most important one. That's it. The subject itself is over now. Okay, but then how is your preparation going on? Are you done with the curriculum questions
I'm
of
on the second chapter.
curriculum questions?
Yes, sir.
So I'm not done with the curriculum chapters yet.
Okay, okay, okay. Second.